Good afternoon. It's Jeff Christian of CPM Group. It's not quite 1 o'clock on the afternoon of Tuesday, the 13th of February here in New York. I'm going to talk today, update on the precious metals markets. I was away last week on family issues. And I also talk about inflation as a negative for gold and silver. We had the U.S. CPI for January come out this morning, and it was higher than a lot of people had expected. I will go through that a little bit later. And that led to a sharp sell-off across commodities and other financial markets. The Dow Jones was off 400 points a little while ago when I looked at it. Gold got down to 2002. It's around 2005. Silver got to 2205. It's a little bit higher right now. Platinum and palladium are lower, and palladium is now at a larger discount to platinum. But let's talk about the markets first. They continue to tread water. Gold has moved into a slightly higher range, but it's basically been trading sideways, as you can see here, for several months now, and it continues to. It did fall, as I said this morning, but it remained within this range. These metals are basically range-bound, gold and silver, waiting for significant issues to take them out of the range that you've been in, either bad economic and political or financial issues that could take gold over 2100, or better and stronger world economic and political conditions, which don't seem likely, which could take gold below 2000. Silver also has been range bound, 22 to really about $23 over the last month or so. We expect it to continue to be that way. We saw weakness today, but the prices are staying within their ranges, and frankly, we expect them to. Platinum and palladium, slightly different story. They both moved lower, and palladium has moved back to a discount to platinum. Palladium this morning got down to around $860 some odd dollars. And platinum is around $890 some odd dollars. So you have a wider discount. They declined today, the 13th of January, in line with other financial assets in reaction to the stronger inflation data that came out for the United States for January. But in general, they have been weakening because of bearish investor expectations for platinum and palladium use in auto catalysts in 2024 and beyond. You see short-term and long-term concerns about auto demand and demand for new automobiles, and specifically demand for vehicles that burn petroleum products, either gasoline or diesel. And that is weighing on these prices, and it's likely to continue to weigh on them for this year and beyond. Turning to inflation. Inflation on a month-to-month rate was 0.3% this year, in January, 0.31%. And that is higher than it has been for 3 or 4 months. It just shows the markets that, as the Fed has been saying, we are not out of the inflation woods. There are inflationary pressures. Not hyperinflationary pressures, but inflationary pressures. If you look at it over the last 12 months, you can see here now, all items, which include the more volatile food and energy, have been falling faster and are lower than the core inflation, which excludes the volatile food and energy. And that's very important to understand, because if you look at that headline inflation, it was 3.1%, which is down sharply from 9% a year and a half ago. It would give you the impression that the inflation fight is going much better than perhaps it is. Core inflation was about 3.9% year over year. That's important because if you look at it and you say, well, where are the inflationary pressures and what is causing the headline inflation to be lower rates of increase than the core, you see what the Fed is watching. Food prices have come off 2.6% year over year. That's not that far off from their mark. And if you disaggregate it, I'll just look over here. Food purchased for consumption at home was 1.2% increase in January, while food bought for away from home, restaurants, was up around 5.1%. So much stronger increases at restaurants than in the grocery store. The big declines were in petroleum products, specifically gasoline, heating oil, and natural gas. And those energy as a total fell 4.5%. But you start looking at fuel oil off 14%, natural gas off 17.8%. That is what caused that headline inflation to be 3.1%, while the core is 3.9%. So you're seeing lower inflation figures on a very volatile energy market, which is problematic and worrisome because that'll flood back and forth. It can go back up in a moment's notice, given the uncertain nature of things in Europe and the Middle East right now. So it creates a situation where you say, well, we can applaud ourselves for having 3.1% inflation, but we have to be realistic. Inflation, the core inflation, is really 3.9%. We still have a long way to go to get down to 2% or close to 2% inflation. If you look at that core inflation, basically a lot of things are looking well. What we call commodities, goods in the consumer pricing, they were 0.2%, pretty good. But services were 5.4%. And specifically, you had a 6% increase in shelter, rent and mortgages payments, and quasi other costs of your shelter, your home. 6%, very high. And transportation services were 9.5%. So that's where you're seeing your inflationary pressures. Transportation services, and shelter, specifically rent and the costs of homes and the costs of mortgages. So that's where your inflation remains. Now, it's interesting because some people think of gold and silver as inflation hedges, and they are broadly, but they don't move tick for tick. But what we're seeing here with the January data in the markets today is that financial markets are looking at the high inflation and saying this is going to keep interest rates higher longer than we would have liked or hoped or prayed for. And that means that financial assets, including gold and silver, probably could be weaker prices, see weaker prices and maybe even lower prices for a longer period of time. So higher inflation is actually a negative for gold and silver on the short term today. That'll change as the year progresses, we think. That's what I have for today. As I said a couple of weeks ago when we were talking about our copper market outlooks, CPM Group doesn't do just precious metals. We also do all six base metals that trade on the LME. We do specialty metals, including high purity manganese, molybdenum, tantalum, niobium, uranium, cobalt, titanium. We have a range of services. We have a monthly base metals advisory. We have long-term outlooks with 5, 10, and even longer term for some things like high purity manganese and platinum and palladium. And we do specialized reports and consulting. I'm back. We'll continue and we'll resume these videos now. And at the end of this month, we'll do our Silver Facts and Fantasies, open free webinar that we started in 2021 in lieu of a silver reception at the Prospector and Developers Association of Canada, which was didn't hold a conference that year because of the COVID and the lockdown. And when they restarted in 2022, we restarted our silver receptions. But our sponsors of these silver receptions asked us to continue with the Silver Fact and Fantasies. And given the reappearance of some fantasia like beliefs about silver and allegations and just nonsensical comments. We're back where we were in 2021 with a lot of people saying things that just patently are not true about silver. So facts and fantasies make sense once again. And we'll be talking about what's really going on in solar photovoltaic panels and other issues in that you can go to our website and you can sign up to participate in that. You can pre-order our Gold, Silver, or Platinum Group yearbooks. And you can contact us either through our website or at info@cpmgroup.com to discuss with us ways that we can help you either preserve the value of your precious metals and other commodity investments or enhance them and possibly even generate profits. Thank you. Take care of yourself. Take care of those around you. Try to do something good for the world. And we'll be talking to you later this week.